Anthony.
Thank you. My name is Anthony Diazdi. I'm a partner at the law offices of Diazdi, Cheng and Liu, and I predominantly practice in the area of cross-border transactions and cross-border tax disputes. Okay, so we're going to be going through quite a bit of information today, but I think this is a very, very thick and complicated topic. So I think what we're going to do is we'll kind of go through steps as we work our way into discussing how foreign cloud computing transactions operate. So we'll first start off with the basic rules involving how a foreign corporation or a non-resident's taxed in the U.S. because that serves as the basis point for the taxing of foreign intellectual property that is being conducted over the cloud or through the internet. Then we're going to go through the software rules, and then we're going to head on over to and discuss the foreign cloud computing transactions. And then if we have time, we'll go through some treaties and discuss the relevance of tax treaties to what we're talking about today. All right. So as I mentioned, the basis for when you're dealing with taxing of a foreign cloud computing transaction is the taxation of a foreign person or a foreign corporation. So there are two ways that a foreign individual or a foreign person can be taxed in the US. So let's start off first with effectively connected income. So if a foreign corporation or a foreign person conducts a trade or a business in the United States, that's considered effectively connected income, and that is taxed in the US at ordinary rates. Your standard marginal tax brackets will apply, and your standard deductions will apply as well. The problem is that the regulations do not actually go ahead and define the term trade or business. But basically, how most tax professionals will define the term a U.S. trade or business as basically when you have a foreign corporation, a foreign entity, or a foreign individual basically conducting business in the U.S. on a continuous and regular manner and engaged in for profit. Okay. Then there's another way of taxing foreign corporations or individuals, and that's basically you're going to be subject to the so-called FDAP rules. And what these FDAP rules provides is that if you have a foreign individual or a foreign company basically conducting business in the U.S., and it's not a trade or business, there is a 30% withholding from any kind of, or should I say, from the gross income being paid to that individual or that company. So you have a 30% withholding, and it's not subject to any types of deductions in connection with any costs. So there's no deductions against it. The one exception to that rule is that if you have a treaty with that foreign individual or that foreign company is a resident of, that individual or that company can go ahead and take a treaty position to either reduce or eliminate that 30% withholding. All right. All right. So the next important step when we're talking about the taxation of cloud income, or you're talking about taxation of any kind of computer programs, you have to look at the sourcing rules. And the sourcing rules are very, very important when it comes time for determining how or if any tax is going to be applied to a transaction. So think of it this way. The U.S. taxes U.S. persons on their worldwide income, right? So the sourcing rules are not really all that important when you're applying it to a U.S. person, other than, let's just say, you're taking consideration a foreign tax credit, because the U.S. person is subject to income tax on a worldwide income. So it really doesn't have much play or much impact on a U.S. person when you're talking about taxation. It totally changes when you're dealing with the taxation of a foreign person. All right. Think of the sourcing rules as basically a boundary for U.S. taxation. Okay. So The U.S. has the ability to tax the gross income of a foreign person's U.S. source income. All right. It's either U.S. source business income or non-business income. And we discussed it before. It's either taxed at ordinary rates if it's business income, and it's taxed at 30% flat rate if it's non-business income. But if the foreign individual has foreign source income, the foreign source income itself, under the sourcing rule, is not subject to U.S. tax. As we'll see a little bit later on, that really becomes important when we're dealing with taxing of any type of digital type transaction. All right. So when you're dealing with sourcing, the sourcing rules are kind of broken down by categories, right? So when you're dealing with a foreign individual, the sourcing rules for gross income is broken down into categories of interest, dividend income, personal service income, rentals, royalties, or gains of disposition of property. The rules are all a little bit different when we're dealing with the sourcing rules for these types of income. So whenever we're dealing with any type of, say, digital transaction, we have to always kind of determine what type of income we're looking at, and then we have to kind of go ahead and source it to the appropriate category. So when we apply the sourcing rule to compensation, the compensation for personal services, so let's just say you have a foreign individual that is performing personal services within the United States, that under the sourcing rule, those services are going to be classified as U.S. source income, and it's going to be subject to U.S. tax. However, if the personal services are performed outside the U.S. and they're foreign source, it's not subject to taxation in the U.S. All right. Now, the sourcing rules for rentals and royalties, it's a little bit different. So basically, rentals and royalties are U.S. source income if the property is located and used in the United States. It is foreign source income if the property is located and used outside the United States. Now, all facts and circumstances will kind of take into consideration how are you going to go ahead and determine how you apply the sourcing rules. You don't use the contract. You kind of use the facts and circumstances to determine, how to go ahead and apply your sourcing rules to rental income and royalties. All right. And then the characterization of income as royalty rather than gain from a sale depends not only on where the intangible is actually used, but where it's entitled to legal protection. All right. So if you're dealing with royalty income from an item or an asset, and there's royalty income being received from it, depending on where you have legal protection, that is where you're going to have, or that country will have that right to go ahead and tax that royalty income. And once again, we're applying this to foreign individuals, foreign corporations. So if the legal protections outside the U.S., the royalty income may potentially not be subject to U.S. taxation. However, the item itself is in the U.S., that might be a little bit different story. All right. So now let's kind of jump in a little bit to the software rules. Okay, this is probably the most important concept when you're talking about governing the taxation of digital transactions. And it's set for the software rules are set forth in Treasury Regulation 1.861-18. And according to the Treasury regulations, this basically, the way that it applies, it applies to how you tax a foreign computer program. All right. So I guess the first step for us to kind of jump into is, well, how do we define a computer program? According to regulations, a computer program is a set of statements or instructions that can be used directly or indirectly in a computer in order to bring about a certain result. For this paragraph, a computer program can include media, user manuals, documentation, database, or similar items if the media and manual is used for the operation of a computer program. Okay. Now, the software rules state that a transaction must be based on substance rather than form. In other words, a transaction will not be classified on how it's described in an agreement. Rather, the agreement itself, so let's just say an agreement states that the software is licensed, it will not necessarily be treated as a license for purposes of US tax. Rather, you have to kind of take into consideration all the facts and circumstances in determining how the software rules will apply to tax, an item itself. So, for purposes of the software rules, a program can be taxed, can be classified either as a sale of property, which can be classified as either inventory or not inventory, a license, a lease, or a service. So for purposes of the sale of property in the context of the software rules, the Treasury regulations provide and take into consideration all the facts and circumstances. There must be a transfer of all substantial rights in the copyright to the software, or a transfer of a copyrighted article. All right. A transfer of a copyright will result for federal income tax purposes if an individual acquires any of the following: the right to make copies of the computer program for purposes of distribution to the public by sale or other transfer of ownership, or by rental, lease, or lending; the right to prepare a derivative computer program based upon a copyrighted program, or the right to make a public performance of the computer program, or the right to publicly display a computer program. If there has been a transfer of copyrights, the issue is whether the transfer itself is a sale. Generally, taxable gain or a license generating from royalty income, once again, will determine the facts and circumstances. If the transaction will be a taxable sale, that takes into consideration all the facts and circumstances, the principles of Internal Revenue Code section 1222 related to capital gains and losses will apply. Okay. If the transferee acquires a copy of a computer program but does not acquire any other rights we just talked about, the transaction is characterized as a transfer of a copyrighted article. A copyrighted article is a copy of a computer program for which work can be perceived, reproduced, or otherwise communicated. Further, the electronic transfer of a software can constitute the transfer of a copyrighted article. Once it is determined that there has been a transfer of a copyrighted article, analysis of the facts and circumstances, including the intent of the parties as evidenced by their agreement and contact, may lead the parties as to evidence of the conclusion of whether or not it was a sale, or if the transaction itself involves the provisions of a service. All right, so I guess the best way we can kind of look at this is, let's take a look at some of the rules that are discussed in the regulations that can kind of provide a little bit more clarity into how we go ahead and we classify a copyright for purposes of the software rules. So let's look at illustration 1. And for illustration 1, it provides that Corp A owns the copyright in a computer program, program X, and Corp A transfers a disk for the remaining term of the copyright to copy and distribute an unlimited number of copies of program X to Corp B, a country's Z corporation, and grants B a exclusive license for the remaining term of the copyright to copy and distribute an unlimited number of copies of program X in the geographic area of country X, and prepare a derivative work based upon program X to make public performance of Program X and public display Program X. Corp B will pay Corp A a royalty of Y a year for 3 years, which is expected period during which Program X will have commercially viable, exploitable, will have a commercially exploitable value. This example concludes that the transfer should be treated as a sale by Corp A because Corp A transfers to Corp B substantially all rights in the copyright of Program X. This example also illustrates that just because an agreement is classified as a license, it will not be controlling for federal income tax purposes. The fact that Corp A is supposed to receive payment classified as a royalty is not controlling. Okay, let's move on to illustration 2, which kind of discuss a little bit more about how the copyright rules or the software rules apply to digital transactions. Okay, so Corp A in illustration 2 owns the copyright in Program X and copies Program X onto a disk. The disks are placed into boxes covered with wrapper on which is printed, which is generally referred to as a shrink wrap license. The license is stated to be perpetual. The transferee receives the right to use the program on 2 of its computers and the right to make one copy of the program on each machine is essential a step in using the program, and the right to resell the program so long as it destroys copies which it has made. P, as a resident of country X, receives the disk. The example indicates that the label in the contract license is not determinative that since none of the copyrights have been transferred to P, P has acquired a copyright article. These same conclusions are available where the software is available through a website rather than a disk, and that's discussed in the Treasury regulations. Okay, so let's now look at illustration 3. Under illustration 3, Corp A transfers a disk containing Program Y to Corp E, a country Z corporation. In exchange for a lump sum payment, Program Y is a computer program program development in which is used to create other programs consisting of several components, including libraries of reusable software components that serve as a general building block into new software applications. Because a computer program created with use of Program X will not operate unless the libraries are present, the license agreement between Corp A and Corp E grants Corp E the right to distribute any program developing using Program Y. This example concludes that because the copyrights to the libraries are considered de minimis, the transaction is treated as a sale of Program Y, which is a copyrighted article. All right, so for purposes of digital type transactions, the income tax regulations discuss the term rents when attempting to classify leases of software. The term rent is an extremely important concept. In this context, the term rents typically means the amounts that are received for the use or the right to use a intangible property. In other words, the term rents can be defined as payment interest received by an owner in return for permission for use of property loaned in proportion to use. For U.S. tax purposes, rent can be classified mostly as FDAP. For purposes of defining a lease of software, the software rules provide that there must be a transfer of a copyrighted article where the benefits and burdens of ownership has not been transferred. A transfer will be treated as a lease that generates rental income in the circumstances where the benefits and burden of ownership has been transferred, and such individual other than the transferee is the holder of the copyrighted article. So we can discuss how this operates in illustration 4, which is taken from the regulations. And according to illustration 4, Corp A owns copyright in a computer program, Program X, and copies Program X onto disks. The disks are placed into boxes covered with wrapper, upon which it is printed, and that is generally referred to as a shrink wrap license. The transferee receives the right to use the program on 2 of its own computers and the right to make 1 copy of the program on a machine, which is an essential step of Program P. P, a resident of country X, receives the disk, but only for 1 week. This example concludes that the label license is not determinative and none of the copyrights have been transferred to P. P has acquired a copyright article and, based on the facts and circumstances, is not the owner of the copyright article. Therefore, there has been a lease of the copyright article, and Corp A recognizes rental income. It should be noted that the same type of the same example would also apply if you're having a download from a website rather than a disk. Okay. According to the software rules, to be a license, all the facts and circumstances must be considered. But basically, the transfer itself must be for less than all the substantial rights. Thus, the difference between a sale and a license for purposes of the software rule is the amount of rights granted. Typically, the grant of a non-existing copyright right to use electronic software is a license. The income generated by a license is royalty rather than a sale. Royalty income can typically also be classified as FDAP income for U.S. purposes. So let's take a look at illustration 5, which discusses a little bit more, and this is also taken from the regulations. Under illustration 5, Corp A U.S. corporation, transfers a disk containing Program X to Corp D, a foreign corporation engaged in the manufacture and sale of personal computers in country Z. Corp A grants Corp D the non-exclusive right to copy Program X onto the hard drive of an unlimited number of computers which Corp D manufactures and sells to the public. The term of the agreement is for 2 years, which is less than the remaining life of the copyright in Program X. Corp D pays Corp A an amount based on the number of copies of which Program X, number of Program X it loads onto its computers. In this example, Corp D has acquired the copyright right to make copies of Program X and to load copies onto computers it makes and sells. However, after taking into account all the facts and circumstances, Corp D has not acquired all the substantial rights in the copyright of Program X because the agreement between the 2 parties ends at the end of the copyright's remaining life. Thus, there is no sale of a copyright, and instead, D has acquired only a license of Program X in exchange for its obligations to pay royalties to Corp A. Okay, services is another area we're going to talk a little bit more about soon, but services is we've also mentioned earlier is extremely important to the digital economy. And as I indicated, when you're dealing with services, if you're dealing with services outside the U.S., the service is typically not subject to U.S. tax. However, you're dealing with services within the U.S., then you could be dealing with a U.S. tax obligation. So as one can imagine, there has been a lot of manipulation in agreements between parties when we're dealing with a contract for services to try to classify a services contract as one being not U.S. sourced rather than being U.S. sourced. So this is kind of discussed a little bit in illustration 6 from the regulations. And according to illustration 6, it goes as follows: Corp H, a country Z corporation, enters into a license agreement for a new computer program, Program Q. Program Q is to be written by Corp A, and the parties agree that Program Q is completed. The copyright to Program Q will belong to Corp H. Corp H agrees to pay Corp A a fixed monthly sum during the development of the program. If H is dissatisfied with the development of the program, it may cancel the agreement, but Corp H will retain all payments owed prior to the termination. All the payments are labeled royalties. The, the example concludes that, taking into consideration all the facts and circumstances, Corp A is treated as providing services to Corp H because Corp H bears all the risk and loss associated with Program Q and is owner of the copyrights in Program Q. All right. Now, since we have a basis on how the software rules work, let's now move on to the introduction to cloud computing. So what is cloud computing? All right. In general, cloud computing is a provision of information technology resources in the virtual environment. This virtual environment or cloud companies comprises of remote, interconnected computer networks, servers, data storage devices, software applications operated by third parties. Instead of maintaining their own hardware and information technology infrastructure, companies use information technology resources stored on remote third-party servers that are operated by third-party cloud service providers. For instance, a designer may choose to pay Adobe a monthly subscription fee to use Adobe's graphic software application known as Photoshop. The designer in this example is engaged in cloud computing transactions with Adobe. More specifically, in this example, the software or services or SaaS cloud computing model transaction. The designer is obtaining access to software and applications that are stored on servers that Adobe owns and operates remotely. Designer obtains space on Adobe's servers where the designer stores images and other data. Under the SaaS model, the designer no longer needs to install, run, and maintain a program on her internal system. Cloud computing transactions differ from traditional provisions of software transactions. The most significant feature of cloud computing is that it differentiates itself from traditional software transactions, is that cloud computing transactions are entirely in the virtual world. In the past, businesses would purchase a licensed software application in a digital form from an online vendor. Under this business model, sellers would electronically transfer the computer program to the purchaser, who would download the program onto his or her computer for a duration of time. Cloud computing, on the other hand, involves neither physical nor electronic transfer of the possession of a computer program to the purchaser. The program does not reside in a purchase computer. In a cloud computing transaction, the cloud vendor solely provides the purchaser with electronic access to the program. And the only physical component is the vendor's servers. Because the cloud vendor controls the program, a cloud vendor may be characterized as a provision of services rather than a transfer of an intangible asset. By eliminating many of these physical components involving a traditional technology transaction, the cloud reduces any connection between the revenue generating activity and particularly the geographic location. Under current law, a country's taxing authority over a cross-border transaction requires some kind of geographic, some type of nexus with that certain area. that it's conducting business. However, in such a case involving a cloud computing transaction, it can be conducted almost anywhere in the world, and thus, in many cases, you have very little physical nexus with any particular jurisdiction. All right, so that brings us now to the taxation. How does the US attempt to tax cloud computing transactions? Well, approximately 4 years ago, the Treasury Department and the IRS promulgated proposed regulations on how to classify cloud computing transactions and other transactions involving on-demand network access. In particular, the proposed regulations supplement the software rules that we discussed earlier. In cloud computing transactions and other which software rules, which apply to cloud computing transactions and other transactions involving on-demand network access. The proposed regulations have defined cloud transactions to be transactions through which a person obtains on-demand network access to computer hardware digital content and other similar resources other than on-demand network access that is de minimis, taking into account the overall arrangement and surrounding facts of the circumstance of the case. An example of a cloud transaction would be the streaming of music or video, or a transaction involving a mobile device application, or the access through remotely hosted software. For tax purposes, for U.S. tax purposes, the proposed generation provide that a cloud transaction is classified solely as a lease of property or a provision of services, taking into consideration all the relevant factors. Each transaction requires a separate classification unless the transaction is de minimis. The proposed regulations go on to provide a list of factors that determine when a cloud computing transaction will be classified for tax purposes as provisions, should I say, for tax purposes as a provision of services or a lease. So these factors are: number one, the consumer is not in physical possession of the property. Number two, the consumer does not control the property beyond the customer's network access and use of the property. Three, the provider has a right to determine the specific property used in the cloud transaction and replace such property with comparable property. Four, the property is a component of an integrated operation in which the provider has other responsibilities, including ensuring the property is maintained and updated. Number five, the customer does not have a significant economic or possessory interest in the property. Number six, the provider bears any risk of substantial diminished receipts or substantially increased expenditures if there's a non-performance under the contract. And number seven, the provider uses the property concurrently to provide significant services to entities unrelated to the customer. And number eight, the provider's fee is primarily based on the measure of work performed or the level of the consumer's use or customer's use rather than mere passage of time. And number eight, the total contract price exceeds the rental value of the property of the contract period. So let's consider an example when we try to take this all into consideration. An example of a foreign corporate software developer that has created software in which it currently holds intellectual property rights. The foreign corporation has customers in the U.S. that it charges a monthly subscription fee to electronically access software stored on its servers located outside the U.S. Although the proposed regulations address how to classify the foreign corporation's transactions with its U.S. customers as either as a services or a lease, they are silent on how to determine whether the subscription fee paid by the U.S. customers constitute income generated in or sourced in the U.S. In the absence of specific rules, the Treasury has adopted the existing tax principles to the new development of technology. However, because of the unique features of cloud computing, applying these principles to a cloud computing transaction is challenging, to say the least. So in this arrangement with its US customers, which is unlike a traditional software sale where the software sale was purchased and delivered electronically to the customer's computer where it was installed, the foreign developer's customers will neither possess nor store the program on their computers. Instead, the developer, as a cloud computer provider, hosts the program on its software or infrastructure, and the customer has no control over the software. Thus, the cloud vendor, rather than the customer, owns the software. These differences may mean that no transfer takes place when a customer accesses the cloud, and if so, the transaction will probably fall outside of the software rules entirely. Okay, so how could the software rules apply to a cloud computing transaction? Well, the software rules may classify a cloud computing transaction as a transfer of a copyrighted article that gives rise to rental income. A transfer of as we discussed, a transfer of a computer program constitutes a transfer of a copyrighted article if the person acquires a copy of the computer program for which the work can be perceived, reproduced, or otherwise communicated either directly or with the aid of a machine or device, and such a transfer is not de minimis, relevant to the overall transaction. Since the foreign corporate cloud vendor, in our example, transfers online access to its software to U.S. customers in exchange for a monthly fee, none of the transactions transfer any copyrights. The rights obtained by U.S. Customers are similar to rights that it would have acquired through the actual copy of the software, which may arise to rental income. All right. Sourcing rules in relation to cloud computing transactions. So basically, the sourcing rules which apply would be in sections 861 and 865 of the Internal Revenue Code. And basically, the sourcing rules basically would provide that, once again, if the performance of services are once again outside the U.S. compared to inside the U.S., you may have an issue in regards to U.S. taxing it. That's why we start having some confusion on how to go ahead and tax a cloud computing transaction, because it's difficult to actually understand sometimes where the source of the actual income would be, or source of the services, should I say, for purposes of the cloud computing transactions. All right. So another way we can kind of look at how the U.S. can tax a cloud computing transaction is basically if there is a U.S. taxable presence. So the U.S. has the ability to tax a foreign cloud computing or a cloud computing transaction if the foreign cloud service provider operates a U.S. trade or business or has a permanent establishment. If that winds up happening, then the U.S. has the authority to tax any active business income the foreign cloud vendor to the extent that is effectively connected in the U.S. Once again, the problem that we're dealing with here is that everything is based upon what goes on in the servers. So if you're dealing with a foreign vendor that is conducting its business or in regards to the software and conducting its business outside the U.S., and the actual business itself is in a server that's located outside the U.S., it's hard to see how the U.S. can actually go ahead and take the position that you're somehow going to have a U.S. taxable presence. Now, where things become a little bit more interesting is, let's just say you have a foreign cloud service provider, and let's just say their business is operated on a U.S. server. If the business is operated on a U.S. server, the U.S. or the Internal Revenue Service, should I say, has a greater opportunity to go ahead and try to classify the activities of the foreign cloud service provider as being a U.S. trader business. Now, case law itself hasn't come around to that conclusion yet. The general case law itself at this point in time seems to indicate, though it's not clear, that if you are dealing with a foreign cloud service provider, and even if the business is operated through a U.S. server, that's probably not going to be enough to draw them into the activity itself being classified as U.S. source trade or business. However, that could change as time goes on. It's just something to kind of keep an eye on. But if you are advising a foreign cloud service provider, and the issue comes up of where their business is being conducted. Is it being conducted through a foreign server or a U.S. server, or there's a possibility to conduct it through a foreign server rather than the U.S. server? It would be well advised to go ahead and have the business provided on have the foreign cloud service provider conduct its business through a foreign server rather than the U.S. server. If you kind of want to make sure that there's least amount of nexus in the United States for purposes of tax, the U.S. tax rules. The more of a nexus that you provide in the U.S., or more nexus of say, a foreign cloud service provider will have in the United States, the greater the possibility that the Internal Revenue Service would go ahead and try to classify that activity itself being provided by the foreign cloud service provider as U.S. Effectively connected income. And if that's the case, then you're talking about its income itself, at least the U.S. part of it, being subject to U.S. taxation at ordinary rates. Now, just because you avoid having a classification of U.S. Effectively connected income, you still always have to look out for your non-business income and for DAP and any kind of analysis when it comes time for a foreign cloud service provider. All right. So the Treasury regulations, and this is particularly Treasury Regulation 1.86118, provides rules for classifying income from computer programs for provision of services or know-how. So under these rules, transactions involving computer programs can be categorized as one of four type of transactions. A transfer of a copyright in a program, which is treated as a sale if all substantial rights in the copyright as to a particular country are transferred. And if less than all substantial rights are transferred, the license generating would be, the income generated from it would be royalty income or license. Number two, a transfer of a copy of a program, which is treated as a sale of a copy if the benefits and burdens of ownership in the copy are transferred, and if it were not a lease generating rental income. Number three, the provisions of services with respect to development or modification of the program, or for the program, the provisions is know-how relating to computer programming techniques where such know-how consists of information subject to trade secrets, protections, and furnished under conditions preventing unauthorized disclosure. So these rules were issued in 1998 and do not directly address cloud computing transactions. So in 2019, the Treasury and the IRS issued proposed regulations that finally sought to categorize cloud computing transactions as either the lease of property or the provision of services. these regulations have yet to be finalized. However, at least they provide us with some guidance when we're dealing with cloud computing transactions. So, Section 7701E1 identified 6 factors, each of which, if true, would be weighted in favor of characterizing a transaction as a lease instead of services. These 6 factors are: number 1, the customer is in physical possession of the property. Number 2, the customer controls the property. Number 3, the customer has a significant economic or possessory interest in the property. Number 4, the provider does not bear any significant risk of substantially diminishing receipts or substantial increased expenditures if there's non-performance under the contract. Number 5, the provider does not use the property concurrently to provide significant services to entities unrelated to the consumer. And number 6, the total contract price does not substantially exceed the rental value of the property for the contract period. These 6 factors are neither weighted nor all-inclusive, okay? So these are factors that should be kind of considered when you're kind of determining how to go ahead and apply or determine how you should go ahead and tax a transaction involving cloud computing. Now, obviously, if you're dealing with a client that is a foreign provider, you're definitely going to go ahead and try to classify it more as provision services rather than a lease. So it's very important to kind of go through each and every single one of these factors here to make that determination on how you're going to go ahead and classify your transaction. Okay. Now, when you have foreign source income involving a digital transaction, whether it's going to be coming from the cloud or any other way, usually, as I mentioned earlier, treaties are going to kind of come into play. All right, but before we get to that point, let's just say you're dealing with services compared to any other type of classification. When you're dealing with the classification of a cloud computing transaction or the type of digital transaction. So if you're dealing with services, the issue is whenever you're dealing with the U.S., you could have the situation, as I mentioned earlier, of a 30% withholding. But if you're dealing with services don't come underneath a treaty, and the best way to kind of deal with it would be in your contract itself. So, when you're dealing with a foreign service provider and you're dealing with the issue of services, and you want to try avoiding the 30% withholding, let's just say this is not an area of U.S. trade or business, you should clearly state in your agreement itself that you're dealing with services and the services are being provided for outside the United States. If that is done and it's done properly, that could put the U.S. payer of any kind of income from a cloud computing transaction or any other type of digital transaction on notice that this is once again, if the facts and circumstances go ahead and reflect this, that we're dealing with services are being provided for outside the United States, and if it's drafted into the contract, that should be enough there to put the so-called withholding agent on notice not to withhold. All right. Now, let's just say we're now dealing with a matter that would be subject to the 30% flat tax. Let's just say we're dealing with royalty income, and it's subject to the 30% withholding. So how is that usually dealt with? What's usually dealt with by if you're dealing with a service provider that is a resident of a country that we have a treaty with, then they would typically, that company or that individual would wind up completing a Form W-8 Ben, sending that out to the so-called withholding agent, and you take the treaty position. And then we're looking at either an elimination of the withholding, or we're looking at a reduction of the withholding. So it kind of depends, right? Now, if we're dealing with a US person that has an interest in a foreign company, right, that is providing services to the United States through the cloud or any other means, or just general worldwide income, we're not going to be so concerned with FDAP, or we're not going to be so concerned with the effectively connected income and trade or business. In that case, the U.S. person that has an interest in a foreign entity will be taxed. It could be taxed in a number of different ways, but if we're dealing with a foreign entity that is providing these services, you could very well have the anti-deferral regimes kick in, such as GILTI or Subpart F income, which could wind up taxing it. So you always have to kind of take a look when you're dealing with, these type of transactions, who your parties are. Will a treaty apply? Will a treaty not apply? Or is it totally, even though you're having money being received from the U.S., does it avoid U.S. taxation because you're dealing with services income that is provided, that's being performed outside the U.S., and since it's services income, it's not subject to U.S. tax. All right. Now, let's just say we're dealing with a company that has established its residence in a country that the U.S. doesn't have a treaty with. Let's just say we're dealing with a company out of Singapore or Taiwan or a number of other countries that we don't have a treaty with. And let's just say that that company itself is concerned about the 30% withholding. Was there anything that that company can do to potentially avoid the 30% withholding? And for purposes of what I'm going through now, I'm going to just limit this to the FDAP income. You can utilize all kinds of treaty planning for all different types of income, but for purposes of what I'm going to talk about, we're going to be talking about purely FDAP income. So let's just say we are looking at a company that is, a resident of a non-treaty country. Well, what can they do? So is it possible for this entity, since you can operate your business, your business, since your business is basically conducted through a server, can you set up your server? Can you set up your business in a country that the U.S. has a treaty with? Is it possible to do that and still go ahead and take the favorable treaty positions in that country that this entity itself, which is organized originally, or they say the owners of this company are residents of a country that the U.S. does not have a treaty with? Well, let's go through the process if this can be done. All right, and I think the first thing we have to kind of take a look at is the general issue of the U.S. treaties. Most treaties that the U.S. has with foreign countries, the U.S. insists on having what's called a limitation of benefits provision. All right, and basically what a limitation of benefits provision is, or LOBE, basically it's there to curtail treaty shopping. So basically this prevents residents of a country that the U.S. doesn't have a treaty with to kind of go over to another country. All right. Now it doesn't mean that another country, a entity cannot set up or says residents of a country that we don't have a treaty with cannot set up an entity in a country that we do have a treaty with, but there is a number of rules that needs to kind of go through to satisfy the so-called LOBE provisions, which are very applicable when we're looking at taking advantage of a treaty. All right. So in some cases, a foreign tech company may be able to utilize a treaty between the U.S. and the third country to reduce or eliminate U.S. withholding on royalty income. Now, understand that each and every single treaty is different. So, it's kind of hard for me to kind of go through each and every single treaty. So what I'm going to be talking about here is just general overview of treaties. All right. Um, so, so basically, what has to happen here is he has to it's a general how to satisfy a number of tests, I guess is the best way to put it. And for purposes of what I'm going to be talking about, I'm going to be using the general model of the 2016 model treaty, which will kind of go through these tests itself. All right. So the first test is the public company trust. So if basically one of these tests are satisfied, you may have a situation, at least for purposes of the treaty, where members of one country can utilize a treaty of a third country to take advantage of that third country's treaty to eliminate or reduce the 30% withholding on royalty income from a digital transaction or a cloud transaction. All right. So under the publicly traded company test, which is discussed in the 2016 model treaty, a corporation must be a publicly traded company, which is defined as a company whose principal class of shares is regularly traded on one or more recognized stock exchanges, and either such shares are primarily traded or primarily traded on and recognized stock market. And number two, the corporation's primary place of management and control is in that contracting state where the company or the corporation is a resident. So basically here, what you have to have is a publicly traded company, even though shareholders may not be a member or residents of that country. It's a publicly traded company, and the primary place of business would be in this third country what the U.S. has a treaty with. All right. The next test is the ownership-based erosion test. The ownership-based erosion test in the 2016 model treaty consists of two parts, both of which must be satisfied. The first part addresses the composition of the corporation's owners and requires at least 50% of the aggregate voting power and value of the corporation shares to be owned directly or indirectly by owners who are residents of the same contracting state where the corporation is a resident. These owners must own their shares in the corporations for a period of time equal to at least 1/2 of the corporation's taxable year, and such owner must be an individual of the contracting state, or a publicly traded company, or a qualified pension or tax-exempt organization. The second part of the ownership-based erosion test specifically provides that during a taxable year, not more than 50% or more of the gross income is subject to this limitation. So basically, what you have to have is a payment is subject to 50% or more. It's deductible for tax purposes in the contracting state where the resident itself, where the corporation is a resident. So you kind of have to satisfy this rule or in order of the base erosion test in order to basically take advantage of a third country. All right. So let's talk now more about the active trader business test. This is a little bit easier to satisfy. So under the active trader business test in the 2016 model treaty, a corporate resident that is engaged in the active conduct of a trade or business in its country of residency is entitled to treaty benefits on income derived from the source country to the extent that such income emulates from is incidental to that trade or business. Moreover, if the income is derived from any trade or business actively conducted by the corporation in the same country, it must be substantial relation to its trade or business of the source country. Whether a trade or business is active and substantial for these purposes is determined by the facts and circumstances of each case. Under this test, active trade or business generally involves specific unified groups constituting or could constitute an independent economic enterprise that is carried for profit. In disregard, the corporation's officers or employees must carry out substantial managerial operations and activities as a trade or business. An active trade or business does not include holding companies, group financing, group supervision, and the administration or making of managerial investments. Activities conducted by persons could then be contributed to the corporation as long as it satisfied the active trade or business test. Then there's going to be derivative benefits test. Okay, the purpose of the derivative benefits test is actually to expand the treaty benefits to corporate residents that are either of either contracting state with respect to an item of income. This test applies to closely held corporations that cannot otherwise qualify for treaty benefits for the other tests discussed above. Similar to the ownership test, ownership base erosion test, the derivative benefits test in the 2016 model treaty also consists of two parts, both of which must be satisfied. The first part requires at least 95% of the aggregate voting power and value of the corporation to be owned directly, indirectly by 7 or fewer shareholders who are equivalent beneficiaries. An equivalent beneficiary is a person who is a resident of another country that has entered into its own bilateral income tax treaty with the U.S. and who is entitled to benefits of another treaty as either an individual of the contracting state, a publicly traded company, a qualified pension fund, or a tax-exempt organization within the meaning of the treaty. However, the benefits afforded to the person by the other treaty or domestic law or international agreement must be at least as favorable as the ones afforded by the current treaty under which the person is equivalent beneficiary. For example, if the other treaty is subject the person to a tax rate on dividends, interest, and royalties that is higher than the applicable rate under the treaty, then the person would be disqualified from being an equivalent beneficiary under the current treaty. The second part of the derivative benefits test mirrors that of the ownership erosion test, in that it too limits corporations' payments that are deductible for purposes of the contracting state, where the corporation is a resident of and must be 15% of its gross income for a taxable year. However, the second part of both tests differ on who they can define as a restricted recipient of the deductible income. In the case of the derivative benefits test, restricted recipients include recipients who are not equivalent beneficiaries, recipients who are equivalent beneficiaries only because they function as a headquarters company for a multinational company group consisting of a corporation and its subsidies, and recipients who are equivalent beneficiaries that are connected to the corporation by at least 50% ownership and benefit from a special tax regime with respect to the deductible payment. So equivalent beneficiaries under the derivative test. So let's try to break this down on how this can actually be used by a individual from a country or a company from a country that we don't have a treaty with. All right. So the following U.S. treaties, tax treaties, contain derivative benefit provisions in their lobe articles: Belgium, Canada, Denmark, Finland, France, Germany, Iceland, Netherlands, Sweden, Switzerland, and United Kingdom. Okay, each of these treaties have a equivalent beneficiary definition. For example, the U.S. treaty with Canada and Jamaica, like the 2016 U.S. model treaty, broadly allows residents of any jurisdiction that has an income tax treaty with the U.S. to be treated as a equivalent beneficiary. In contrast, the U.S. treaties with Belgium, Sweden, and Finland limit equivalent beneficiaries to a country in the EU or EEU residents of a NAFTA country, and residents of Switzerland. The U.S. treaty with Mexico is even narrower, limiting equivalent beneficiaries to residents of a NAFTA country. In addition to these country residency requirements, each treaty has requirements that equivalent beneficiaries must satisfy in order to meet the derivative benefits test. For example, the derivative benefits test in most treaties are similar to the 2016 U.S. model treaty, and that they require the equivalent beneficiary to be entitled to the beneficiaries of the other bilateral income tax treaty as an individual, a qualified contracting state, a public traded company, a pension fund, et cetera, et cetera. So how would this kind of wind up working out? So the way let's just use an example from Hungary. So let's just say, and the reason I use Hungary is because the U.S. treaty will be terminating with Hungary at the end of the year. So let's just say we're dealing with a Hungarian tech company, and let's just say the Hungarian tech company now wants to go ahead and set up an operation in another country. Let's just, it could be Luxembourg or UK or wherever. So how does this rule apply for equivalent beneficiary purposes? So let's just use, so let's just say Hungary goes ahead and establishes a company in another EU country. Since Hungary is a member of the EU, and since under the equivalent beneficiary provisions, Hungarian citizens can go ahead and establish a entity that is located in another EU country. It may be possible in this case for Hungarian residents to use an income tax treaty from another country. That is as long as it's conducting an active trade or business and so forth. Now, it becomes a little bit more complicated whether or not, say, countries outside the EU, let's just say Singapore or Taiwan, whether they can actually go ahead and establish a residency in a treaty country. Right now, it kind of looks like it's more or less geared for more of European type countries. But anyway, it's something that it should be considered in any kind of cross-border planning whenever you're dealing with a entity itself that is located, or it's located in a country that the U.S. does not have a treaty with. So the problem is that the analysis itself does not end with a treaty. Just because, let's just say the U.S. let's just say the residents of a country now go ahead and find they're able to go ahead and set up an organization in a country that the U.S. has a treaty. Under the treaty, there is something called the conduit finance rules, and basically, prior to a couple of years ago, this was, the conduit finance rules were not as much of a concern. So what are the conduit finance rules? The conduit finance rules are enacted in Internal Revenue Code section 7701I, and basically it prevents the claiming of a treaty provision with respect to royalty payments. And basically the conduit finance rules apply to multi-party financing arrangements that are classified as basically a transaction between any two or more parties involved. So why the conduit finance rules are so important and how they apply is that, let's just say you have an entity in country A that doesn't have a treaty with the U.S. Now, the residents of country A now go to country B, set up an entity in country B for purposes of taking advantage of the U.S. treaty with country B. You basically now have to worry about your conduit finance rules because now you have a multi-party transaction, and it anything can be classified under these rules as a financing arrangement. So if you're dealing with you're dealing with a transaction that involves multi parties, where you're having individuals from country A trying to use country B, always look at your conduit finance rules. And as I mentioned earlier, it wasn't much of an issue because prior to a couple years ago, the conduit finance rules only really applied to interest payments. There was other rules in the code that can go ahead and attack a royalty payment, but predominantly the way that this would work is that it was really going after cross-border type of financing transactions where you're dealing with trying to defeat the withholding on any type of interest. So with the enactment of the conduit finance, what happened was a couple years back, Congress went ahead. When I say a couple years back, I say the 2017 Tax Cuts and Jobs Act. The IRS went ahead and they enacted new conduit regulations. And the new conduit regulations basically now go ahead and attack any type of a transaction that deals with a license and multi-party licensing agreements when you're utilizing a treaty type of a position to defeat a U.S. withholding. So, and it also applies when you're dealing with hybrid entities, and it also applies when you're dealing with a hybrid type of contracts. So, in any event, always if you're looking at a complicated foreign entity that has multiple levels, where let's just say its headquarters are in country A, but it has subs in country B and C and so forth, and then the entity itself, this complicated entity, is looking to take advantage of a treaty to reduce or eliminate a 30% withholding on any type of digital transaction in the U.S., including a cloud transaction. Always go ahead and take a look at your treaties, see if the treaties itself will apply. Also go ahead and apply your anti-conduit regulations, see if the transaction itself constitutes a financing transaction. In most cases it will, but one last thought on the anti-conduit rules is that the burden of proof on these type of transactions is on the Internal Revenue Service, that the arrangement itself was set up to avoid or eliminate a U.S. withholding. So always understand that the burden of proof is going to fall on the government, but that should not mean that you should let your guard down when you're applying these rules in context when you're dealing with a complicated type of entity with multiple subs and multiple brother and sister companies in a number of different jurisdictions. Okay, so we went over quite a bit today in regards to the conduit regulations, the software rules, the anti-conduit rules. I have put together a detailed article on this, which may explain it better than my presentation, or can I maybe add to it. If you would like to obtain a copy of it, please feel free to send me an email